It's great to be here speaking to you about a reasonably new paper that we have started, which is looking at the response of firms when they list. And what we're using is a new market that has been developed in India over the last 10 years by regulatory diktat. Okay, this is not something that's sprung from the market, but it's something that the regulator chose to put in place. And I think that provides for some interesting thought around the law and regulatory interventions and how do we measure the impact, following up on what Elizabeth and Margaret have been talking. So the question really here is that the economic question is, when you have small firms and they choose to list on an exchange, is it actually something that benefits them? Okay, and the context is like this, that we have seen, and this is historical evidence all across the world, it's not specific to an emerging economy or a developed market, that size tends to be correlated with productivity. So the larger you are, the larger the business model that you can support. One of the things that we observe in India is that we have a very large number of small firms, and very few of them manage to break out of their size constraints and reach into a big, large either manufacturing or services. This is something that is endemic in India, and we see it all the time, and it's persistent. This is not something that's a new phenomenon. It's been around forever. So the standard finance reasoning is that smaller firms face a higher level of information asymmetry, and that's what drives their financing constraints. So potentially, of course, this is a bigger problem in the emerging economies because the degree of information asymmetry tends to be larger in emerging economies as compared with the developed markets, but this is the core of the idea, and therefore it stands to reason that if these firms then go ahead and list on an exchange, it becomes a publicly traded firm. To whatever extent there is liquidity and trading on that firm's shares on the exchange, and the exchange puts the price out in the public, that's a new signal about the quality and the value of the firm. So if this is the case, if the core is that it is information asymmetry that drives the financing constraint, then the premise should be that the moment that the firms choose to list and there is trading activity on these firms, then you should get firms that have a higher access to finance, and that should lead to a higher probability of the firms becoming larger. So the question is, can listing jumpstart more firms out of the stagnation that we see and into the ranks of firms which have better access to finance? And that's the question that we're grappling with over here. And the opportunity that we have looking at the Indian data and the institutional setup is that in 2010, the regulator of the equities markets, that's the Securities and Exchanges Board of India, lovingly called SEBI, issued guidelines to set up dedicated, what they called small and medium enterprise exchanges. Okay, now the term small and medium enterprise, we know that's the SME, is something that is contextual. In different countries, what defines an SME is very different. And if you look at what is the listing criterion for a firm to be eligible to come and list on the SME exchange, it actually has nothing to do with the definition of an SME as per law in India. Okay, what we can read when we look at what is an SME exchange or what the guidelines of SEBI says is that it's got a diluted requirement of information and size. That's pretty much it, okay? And we'll go through some of that later. But for all practical purposes, the listing criterion compared with, say, a main board listing is that you have lower requirement of net worth, you have lower requirement of paid up capital assets, the size of the issue is smaller, and you don't have to show a track record for 5 years, which is what is the norm for a main board listing. It's something like 2 years, 3 years, and in one of the exchanges, there is none at all, right? So we started this experiment. The diktat was issued in 2010. I think the first listing started in 2012. And by March 2016, what we see is that 129 firms listed on one of the exchange, which is called the Bombay Stock Exchange or the BSE SME. And interestingly enough, out of these 129 firms, 16 firms have actually migrated to the main board. Right? So that seems to be something which is a promising sign. And the national stock exchanges emerge, which is what is their small and medium enterprise exchange platform. Those have been a slower start. There are only 15 firms that have listed there yet. I thought that it would be interesting just put very briefly up on the board what is the listing criterion. So you can see there's net worth, track record, post-issue, paid-up capital, tangible assets, issue size, market cap, and then some extra things that the exchange can choose to put on the board. What is really nice compared with the other kind of regulatory diktats in India is that in the case of the small and medium enterprise exchanges, the exchanges have been given some amount of freedom to change the criterion, right? Otherwise, in India, typically, regulator puts down a diktat and specifies the rules. That's true for the main board listing criterion, but in the case of the SME exchanges, there's some amount of flexibility. And you'll see that the listing criterion is definitely lower if you want to list on SME, but they do put some constraints on what is the size of the firm that can come to the SME exchange. Okay, so what does this paper do? The paper looks at this as an opportunity to see whether we can assess and do a causal analysis of what should be the impact or what is the impact of listing on the capital structure and the growth of listed firms after they list, right? And what we have in India is access to a database, a very rich corporate database, which allows us to compare the behavior of these firms before they list and after they list to firms that are unlisted. So we also have similar data for unlisted firms. And what we do is that we are able to observe a set of firms which we can match to the firms that chose to be listed, but they chose to remain unlisted, and see whether capital structure of the firms after listing did see a change, and was it an improvement. Okay? So here's the research design. For the econometricians in the room, there is an estimation framework, which is a causal estimation framework, which is called the difference in difference estimations. And if we wanted to capture the causal impact of listing, we divide it into what we call the treated sample. That is the set of firms that actually chose to get listed. And then there is a control pool, which is what we're going to measure the performance against, right? These are the firms that chose not to get listed. Now, you will see that all the firms that listed on the SME exchanges from 2012 to March 2015 is what we've chosen. We haven't gone all the way to 2016 because the availability of data is a constraint. And we see that the treated samples is 54 firms, right? So we've got 54 firms that chose to list and are available for analysis. Now, the control pool is technically all unlisted firms from our database. Now, the database itself has got about 16,000 odd firms, right? But the data of availability is a constraint, so there is some cleaning up that we do to the data, which is exclude firms where we do not have sufficient amount of data in terms of a consistent number of years that we can observe the firm for before and after. And we exclude if data is, the firms if data is unavailable for less than 1 year, or it is unavailable for the period of listing. And of course, we also do some trimming of outliers. If you see egregiously weird numbers for balance sheet data, then those firms are not included in the analysis. Now, that makes us, that gives us access not to 16,000 firms as the control pool, but actually about 10,000 odd firms for the control pool. And that's still a pretty fat period. The period of analysis that we're looking at with respect to the impact on the firms that chose to list is, we look at their capital structure and growth for 3 years before the listing, and similarly a 3-year period after. So that tends to back away from the requirement that the moment you list, you should see some change. No, we give 3 years and ask whether some impact has happened of the listing. So what we do in terms of, the analogy is, of course, everybody might be familiar with this, that from the medical industry, that when you want to see the efficacy of a treatment, you pick a bunch of people, hopefully they'll all be twins, right? And one pool or one sample will have one of the twin and the other twin sits in the other. And therefore you get a perfect match. Of course, with firms, you can't get a perfect match. So we choose to pick firms who are matched in the size of the firm, the age of the firm, and the industry. So these are the matching covariates. So from the control pool, we look at the treated firms and we ask who are the guys in the control pool who are matched with a treated firm on size, age, and industry. And this is some of the detail of the matching methodology. And finally, when we apply this, we see that for all practical purposes, out of the 54 firms that we had, we are able to identify 43 that got listed who can be matched with a pair from the control pool. So you've got 43 as a sample of the treated firms and 41 as the sample of the matched firms. And of course, the data problem still persists because even for the firms that we match on, some of these firms do not have a full 3 years of data compared with the date of the listing. There are two things that we wanted to understand about the behavior of the firms once they chose to list. One, obviously, is the access to finance, because that's our core thesis, that access to finance should improve. And there are a series of variables that focus on the debt access, the kind of equity access, the leverage. The proportion of trade credit appears in this list because for all practical purposes across the board, firms in India get a lot of their debt financing in the form of trade credit. So we include that. And of course, there is also proportion of working capital. Cash holdings and dividend to operating profit are numbers that we put in to capture financial constraints, because if these are very high, then these are firms with constraints on their financial access. And secondly, we looked at efficiency measures, which is about profit to total assets or profits and returns on assets. But this is not something that we focused on as much as compared with the financial constraints. So what are our findings? We find that those firms that listed on what is called the SME exchange saw very little impact on the access to finance all the way from the year that they listed up to 3 years out. So if we thought that there was going to be a remarkable effect on the capital structure and changes in capital structure of the firms that chose to list, this is not happening very clearly, right? Other than the fact that equity capital has grown. So before listing, they had a certain X. After listing, the equity capital of the firms consistently went up. But that's an equity raise, right, in the public. So it's not that startling to see. However, in terms of debt access, it's not happening. Relative to those firms, please let's keep this in mind, relative to those firms that did not choose to list, okay? Firms that listed on the SME exchanges actually ended up seeing a growth in asset sales, working capital, and net worth after listing, but these are weak results, right? These are not very startling. It's not like the change that you see in the equity capital. And we find that firms continue to hold high cash holdings even after listing, which seems to indicate that the stress on access to finance hasn't gone away. Okay, so this is what we have found, and what follows is a detail of the analysis to just persuade you that we've done a good job of it, and you will have access to that on the website. And because I'm the moderator and I don't want accusations of conflict of interest, I'm going to give up my space and time for the analysis to the remaining speakers. But I do want to just to put up on the board for the econometricians in the room. So the difference in difference equation is up here, which is whatever the financial constraint variable is a function of the listing, which is a signal 1 or 0, the year of the listing, and a joint, a combination of listing year dummy and listed dummy, and the beta 3 variable is what is in the table. So please take a look at the slides, and the only thing, as I said, that's significant is the access to capital. All right, thanks. And I guess I'll go back to being the moderator, and I'll take questions from the board.